Hey everyone, it's time for another episode of Mayhem in the Markets, coming to you Saturday, April 29th, and brought to you by macrovisor.com, where we make macro actionable and easy to understand. The first chart here is talking about the quote, soft landing, unquote. And it's interesting because you can see this ratio between the performance of home builders and regional banks hitting an extreme. It's an extreme that the chart we can see has not been hit in 20 years. It may be an all-time high. It's interesting because regional banks are big lenders of mortgages, particularly into their respective regions. Obviously, non-bank origination of mortgages is still a really big chunk of this. But with these regional banks tightening credit standards, as well as other financial institutions practically everywhere, that's likely to have an impact on rates, availability of mortgages, and possibly compress some of these home sales. And the reason I say that is maybe that outperformance of home builders is something that's going to be a little bit short-lived. Why would I say that? Because we do have a shortage of inventory, particularly in existing home sales. And if you think about it, it makes sense, right? Right now, if you locked in a sweetheart mortgage deal, 2-3%, 30-year mortgage, why would you move? And could you move? I mean, you might end up having to move to a smaller home because you're going to have such a high interest rate burden. So home builders are in a sweet spot because of that, because new homes are, a little bit more attractive from that standpoint, right? There's more availability of them coming online. And this means that home builders have had a bit of coasting over the last year. But what's happened over the same time is their backlogs have dropped, their new orders have dropped in some cases by as much as 80%. The prices which they're selling homes into the market has fallen. And then on top of that, the rates for financing new home construction have risen. So the fundamentals of the industry are turning on their head a little bit. And meanwhile, regional banks are continuing to struggle. We just had First Republic fail. And I wanted to take a moment to speak to that because I posted something. I got a lot of flack for it. It shows me that there's some folks that don't really understand how banking works. And I talked to my partner, Aisha, about this. And, she was a corporate banker for 18 years. So she has some more insight than a lot of folks on social media who have no such experience. And what she said, and we can go back and review this and see it's true, is that banks don't survive bank runs. So when that sort of panic is induced and clients begin to pull deposits at a rapid rate, at Silicon Valley Bank, for example, in 4 hours, clients pulled tens of billions of dollars. At First Republic, it was a little bit slower, but was still $100 billion pulled within a quarter and about $70 billion within a month. Banks don't survive that. They simply don't. And people say, oh, but this is such a bank-specific issue. There are mismatches between the duration of assets and liabilities at just about every bank, if not every single bank. And only 6% of those assets are hedged, and it's mostly at the larger banks that have access to those hedging facilities. This is another point Aisha made, that a lot of banks can't even hedge their risk, and they're not able to sell out of these hold-to-maturity securities without taking massive haircuts. So the last 14 years of financial repression, where interest rates were kept very, very low, if not at zero, and QE was entering the system, it created this period where to get yield, you had to reach further and further out in duration, 10 plus years in some cases. And at the same time, your liabilities are things like deposits and CDs, which are very short term. People can pull those out pretty much at any time. Obviously, you take a bit of a penalty to pull out a CD, but banking accounts, savings accounts, you can pull those out pretty much any time. They're liquid. So this idea that the problem of what happened to First Republic or Silicon Valley Bank or some of these others that are either wavering or beginning to fail, these are not unique issues. Any bank that undergoes that level of pressure, that flight of deposits, will fail. And it'll either be bought under by another bank or a consortium of banks, or it will be taken into receivership by the FDIC. This is not complicated. This is a structural issue in the banking system itself. It typically doesn't come up because people don't typically flee. In fact, there used to be laws in many states like California where it was illegal to spread rumors that a bank run was happening to prevent exactly this type of outcome. That law in California was struck down by a judge under the auspices of free speech, sort of like yelling fire in a crowded theater is free speech, I guess. But the bigger point is this, and this is the one that I want to resonate with everyone listening or watching. This is not a unique issue. I put a post out there that really bank hedging is very, very minimal, that the unrealized losses by some measures are over $2 trillion. The deposits against those unrealized losses, something like $22.5 trillion. So if you zoom out, you can see that banks are already in a situation where if there is enough pressure, they can fail, right? Because if you're a bank and you've got a bunch of stuff that you're holding in your loan book and your assets, and you can't liquidate it quickly enough to feed the depositors, you're insolvent, you fail. This is not unique. This is a systemic issue, and it's the very nature that banks work upon, where they borrow from the short end, which is like taking on deposits, and they lend against the long end, right? Or they take on longer duration assets, particularly, again, after over a decade of financial repression. So you could actually put some of the blame on this at the Fed and their policies. You could put some of the blame on this at the risk management of these banks, but you could also put blame for why First Republic and Silicon Valley Bank failed to the people that were out there screaming that the world is going to end and we're all going to die. Peter Thiel told everyone to pull their deposits out of Silicon Valley Bank. That made the situation much worse. David Sachs, his buddy Jason, and other people like Genevieve Rockjector were out there talking about how the banking system is going to fail. And if we don't, and some were putting videos out there of some of these banks showing people queued up at First Republic, for example, to take out their deposits at like 1 or 2 locations. This is a bank that has many more than that, and saying, oh, this must be a bank run. That becomes a self-fulfilling prophecy, because when clients start to hear, hey, your bank is having a run, they pull their money out. And when everyone is running over each other to pull their money out, the bank fails. This is not unique. So, obviously, if anyone has more than $250,000 at any single bank, it might be a good idea to diversify one's banking relationships. It's not a bad idea to be insured. Also important to remember that money markets are not insured. They strive not to break the buck, but they're not insured. So this flight to money markets and people saying, oh, this is safer, arguably it's not. The money markets actually broke in August of 2007, and later in the year again. That was one of the reasons the Fed had to intervene, because the money markets are a very key funding mechanism for this economy. Imagine no groceries on your shelves. Imagine your paycheck not clearing, no gas at the gas station. That was the type of situation that could have played out if the Fed didn't intervene during the great financial crisis. So let's think about that for a second in the context of what's happening today. These bank runs are induced by a lack of liquidity. Now, we'll probably see a solvency crisis later in the year, because you still do have a lot of banks that will be under greater pressure with rates staying high, with credit conditions tightening, with more and more loans going into delinquency and default, and depositors shifting where they want to go. Now, what I like to do is have some money in short-dated treasury bills, because unlike the money market, which parks funds there, when you're directly doing business with the Treasury, guess what? Your money is backed by the full faith and credit of the U.S. government. And if that doesn't work, we've got a much bigger problem to deal with. And no, the dollar is not about to fail tomorrow. I know we've heard this a million times by people out there that have no idea what they're talking about to pump their Bitcoin or their gold or other nonsense. Maybe they're in other currencies. The dollar is not going to fail overnight. It's a process that takes decades, and it may be underway, but it's nowhere close to done. The majority of the world does business in dollars. The most attractive assets in the world are priced in dollars. It's not going anywhere anytime soon. So just think about that in the context of people trying to say, oh, it's all the fault of management. Yes, management has some blame at these banks that have failed, but they're not the only ones to blame. The Fed has some blame. Regulators have blame. It was the Congress in 2018 that lifted the bar from 50 billion and up in assets to be supervised closely to 250 billion and up. Some of these same banks that failed lobbied for that, but that's neither here nor there, because the buck stops with the Congress and the president. So to say, oh, well, it's all their fault. Well, the whole idea after the great financial crisis, what people were supposed to do that were in power overseeing this is make sure it didn't happen again. How do you do that when you loosen the regulations? You don't. These banks should have been more closely supervised. The Fed was also negligent in supervising Silicon Valley Bank and arguably First Republic as well. But then the people that spread these rumors, they're culpable. And I wonder how many of them had positions that would have benefited from the failure of these institutions. Because again, banks don't survive runs. They either get bought under or they get taken into receivership. This is not something you can reverse. You can't reverse a crisis of confidence. And I would encourage everyone who disagrees with that to go and do a lot more reading before coming back with some snarky comments trying to say, oh, no, it's all this or that's fault. It's a convergence of things, but the folks that were spreading the rumors, they're culpable because this wouldn't have happened the way it did without them. Now, later this year, when we get into a full-blown recession, which I think is going to happen, there will be a solvency crisis. And there will be a lot of problems at these banks. We're not there yet. This was a liquidity-induced crisis and had everything to do with a flight of deposits coming out based on fear. And is it a good look for banks to have so many deposits above the 250K insured limit? No, it's not a good look. But buyer beware, know how the system works, make sure you spread your risk around. I would never put more than 250K at a single bank. Why? Because I lived through the great financial crisis. I saw banks failing left and right. And I realized from that experience that you don't concentrate risk. You don't concentrate it at any bank. You don't concentrate it in any position. You don't concentrate it in any particular region or asset class. You spread your risk around. Next chart we have is U.S. government spend is soaring. Someone came back to me and said, don't you understand monetary policy has made this happen, that the interest rates on the U.S. government debt have gone up, and that's why this jump has happened? They could not be more wrong. Yes, interest expenses are going up by a couple $100 billion, and they're going to keep going up. But that's not what this big vertical line to March 23 is from. It's from government spend. The CHIPS and Science Act. The ironically named Inflation Reduction Act, which is doing nothing of the sort. It's stimulating demand when we need it the least. And this kind of spending it's almost as if they're trying to abate the outcome of a recession, just to avoid it. Well, how do you do that? You don't. Not like this. You need to save that ammo because inevitably we do see a recession. And I think it's going to be later this year. And I think the government is going to be kind of tapped out because of where interest rates are now, because a lot of this spending was front loaded during a time of intense inflation before the real recession. And we started to see hints of a recession last year. We had 2 quarters of negative GDP growth. It looked like we were going to get into a recessionary environment. And the government said, no, there's no recession, and just started opening up the floodgates with these spending bills, which made inflation worse. So does, by the way, the perpetual support of war in Ukraine. Regardless of what your political views might be, sending over lots of weapons, that uses resources, that also spurns inflation. And that's not a great thing in the environment we're in now. Putting politics aside, I don't like war of any kind, but when you have a war, it tends to be inflationary, not only because of, the amount of resources it takes, but also because of the disruption in economies. Ukraine is one of the biggest grain exporters in the world. They're exporting a fraction of what they used to. War has a lot to do with that as well. So Russia owns some of that blame too. No one's right when everyone's wrong. But this U.S. government spending is not sustainable, particularly with where rates have risen and how reckless multiple administrations, again, let's not make this political. Multiple administrations have been reckless with government spend. And you can see it on this chart here. Look at that ramp up from the great financial crisis and on. The government is spending an inordinate amount of money, and it's getting very little for it. The amount of GDP growth we get for every dollar spent is de minimis. It takes like $7 of spending to get $1 of GDP growth at best. And with some of the new additions we've had to the Treasury's account from late tax payments, we've extended the point for which resources will be exhausted to late July. So the kabuki theater that is the debt ceiling extension, a manufactured crisis, by the way. We created this crisis again, back to the legislature. Not going to be political. Both parties are at fault for this too. And in some countries, if you can't manage your budget, if you can't manage your spending, they just dissolve the parliament and get new people in that can. I personally think we should do that and also not pay people unless they can figure it out, right? So if you're in the process of not being able to figure it out, suspend their pay. Why are you being paid to not do your job? And then after a certain amount of time, if you can't figure it out, just get rid of everyone. Let's get some fresh blood in there so it doesn't look like a nursing home for legislators, because it's also a bit of a problem. Not trying to sound ageist here, but you got to have people that are going to be alive and have skin in the game to see the outcome of the policies they're making. We don't. So this debt limit, this is going to become an issue And it's not going to be a default. There's no default coming. At least I don't think. I don't have a crystal ball. I can't tell the future. But what I do know is the powers that be, the true people that pull the strings behind the scenes, that literally fund these people's campaigns and their largesse, they don't want a default. So eventually the parties will do the bidding of the powers that be, the financial elite, and they will extend the debt ceiling. It's inevitable, in my opinion. But we can have turbulence along the way. We can see it in credit default swaps. We can see it in some of the bouts of volatility we've had in treasuries. We can also see it in other places. We can see it, I think, in what's happening in the confidence of this government to be able to do its job. We may have a government shutdown, partial or full. We saw that the last couple times there was this debacle, and a government shutdown is bad. I'm not saying that the government should have as many bureaucracies open as it does. I think our government's probably well too big for its own good and for the good of our people. But when you have this sort of sudden shuttering of the government, it presents a whole lot of issues, national security issues among them, because people aren't renewing security products. They aren't updating servers. They are letting the cybersecurity infrastructure be lackadaisically managed during those periods. And there were hacks during some of the prior shutdowns that were very problematic. But the other part of it is, what does this look like to the rest of the world? It looks like we're negligent and incompetent. I think we deserve better leadership. Maybe I'm wrong. Let me know what you think in the comments. Tokyo Core CPI, the highest since April of 1982. Is this a mission accomplished banner? Is this, the Bank of Japan's, we can get Kuroda or Ueda up on an aircraft carrier with a big mission accomplished banner? I don't know, maybe I'm aging myself here, but Bush did that way before the Iraq War was anything resembling one. Mission accomplished, and it wasn't. Is that what we have here? Mission accomplished? We've got inflation, but it's not for the right reasons, right? Their economy is not growing that well. Some of this inflation has to do with the fact that Japan is an import-driven country, whether it's raw resources, materials, energy, agriculture. A lot of this stuff gets imported. Their currency is weakening. We've had supply chain issues that are beginning to work itself out, but still, Japan's in a rough spot. Their new governor just came in and said, status quo, we might change things at some point, but we need to see stronger inflation to get there. It's a dangerous Pandora's box they're opening, but after such a long period of disinflation and deflation, I think we can understand why they were hesitant to normalize policy. The other part of it is the Bank of Japan actually owns more than half of the country's debt. The government of Japan owns about 56 or 55% of the Bank of Japan, which is a weird thing. Like if you're familiar with the graph of a Ouroboros, a snake eating its own tail, that's sort of what this looks like to me. But it's interesting. It's a case study of all the central banking and government decisions we shouldn't make after a real estate crisis, after a financial crisis. And yet a lot of the decisions made in the US after the great financial crisis are quite similar. And it led to a period of lackluster economic growth. Assets went wild. We had one of the best bull markets in history, but the economy, not so much. And there's a lot of people that have been left behind. And Japan is like that, but just take it maybe 10, 15 years forward. And maybe that's more like what we may see here. Last year, Japan had more deaths than births by a lot. And U.S. population growth is slowing. And our immigration policy is not so good. So we're not offsetting it commensurate with what we should be to have the requisite workforce that we're going to need moving forward. Developed market central bank bond purchases are set to fall. The Bank of Japan being the outlier here, where they're continuing down this path by the projections of JP Morgan, who is the bank that created this chart. But the Bank of England, the European Central Bank, the Fed, they're draining liquidity from the system with quantitative tightening. And by the way, the term bank funding facility, or the term bank funding program, bank term funding program, was not QE. It really wasn't. QE was the Fed buying treasuries, buying mortgage-backed securities, putting them on their balance sheet until maturity. This is, you go to the Fed, you give them your agency mortgage-backed securities, the ones that are backed by the full faith and credit of the U.S. government, or the treasuries with that same backing. Many of these assets are yielding 2-3% and change, perhaps, right? They go to that window and they say, hey, we want a loan. The Fed gives them a loan for a year at 4.5 to 4.75%, which means the bank has a negative carry cost. That means they're motivated to get out of that loan as soon as they can. This is not the same stimulus. All stimulus is not created equal. So with that in mind, be careful with some of the narratives out there about what is happening versus what people are saying is happening. We've got a dangerous disconnection here. And I get it. The market's rallied. Everyone thinks this is a sustainable new bull market. But I would exercise some level of caution buying into that, particularly with the valuations we have. Unrealized losses on investment securities at banks still are quite high. This data is a little bit dated, okay, but it's worth watching. This is from the fourth quarter of 2022. That's about the latency we get it from the FDIC. It came out, I want to say in March. The next one's going to come out in early June. Now, what this shows us is there's some level of improvement, but not commensurate to what we need to see to be saying that we're out of the woods. And the Fed has helped to smooth this over because they've offered a facility that provides liquidity on a temporary or ephemeral basis to these banks. It does not resolve the imbalances on their balance sheet. It does not resolve, particularly with the held to maturity securities, the problems that these banks structurally have, which is why, again, you spread rumors about a bank, any one of them can fail if the rumors are deemed credible by their clients at such a scale that they pull out those deposits with a high velocity. They can't keep up with that. That will cause failures. There's a lot wrong with the discourse out there where people are just spreading rumors because it gets them engagement and it causes all kinds of unforeseen consequences. And this is from a paper where the net takeaway is only about 6% of bank assets are hedged. And most of that is hedged at larger banks. And the more vulnerable banks are actually selling their hedges into rising rates. And it's a little bit of an accounting game. You can show that things look better than they really are. But the reality is a lot of these banks, particularly the small and mid-sized ones, are not well hedged for reasons that they don't have access to those tools, or they don't have counterparties that want to do that sort of hedging with them, selling them those swaps, but also because there's been a lot of mismanagement. And that has to do with all the way up to the Fed. All the way up to the Fed, this monetary policy experiment of QE and 0% interest rates for so long has completely perverted the entire risk management paradigm. And so when you add to that the stress of people saying, hey, this bank's insolvent, that bank's having a run, this, that, and the other, that allows some shorts to make a lot of money, but it also creates stress that really no bank could survive. Now, there's exceptions to the rule. There's banks like JP Morgan out there that'll pretty much survive a nuclear holocaust, the way that they're run and how systematically important they are, that they won't be allowed to fail. But a lot of small and mid-sized banks and some of the larger ones are vulnerable if there is a crisis of confidence in the near term. And in the longer term, we're going to have some solvency issues in the back half of this year. I'm not identifying particular banks because I recommend people do their homework. And again, maybe don't have more than $250,000 at a single bank because it's not insured. Net percentage of banks tightening lending standards to commercial and industrial loans. This is pretty high. It's really a problem that we should be taking a very, very close look at. The number right now is 44.8% that are tightening, because this is to the large and middle market firms. What about the small businesses? What about the consumers? The data we have shows that tightening is even more severe. We've never seen this amount of tightening of lending conditions without a recession following. I don't believe this time will be different. We are in a credit-driven economy. There's been some people saying that this economic expansion is driven by rising wages. That's a complete misinterpretation of the data. And if you look at wage growth in real terms, it's not really rising. It's only risen really in the last month or so. Inflation outpaced real wage growth, which is why consumers are borrowing over $1 trillion. I mean, we've now hit a record amount on credit cards. They're borrowing $1 trillion from these revolving lines of credit, not because they want to, but to pay bills. They're also using buy now, pay later to pay grocery bills. The credit expansion, just like we saw in government spending on a prior chart, is what's driving the economy. Don't believe me? Look at Q4 GDP or Q1 GDP. Q4 GDP, one of the biggest items was inventory building. That's done on credit for large stores. It was also non-defense government spending. That's done on credit because they're borrowing to do it. Okay? So think about it from the context of what's actually happening versus just taking data in a vacuum and extrapolating it to mean something it doesn't. Wage growth is feeding inflation. It's not feeding economic growth. It may have helped to buoy it a little bit. That is to say, perhaps it'd be worse without it. But this is a credit-driven economy. It remains a credit-driven economy. It will continue to be a credit-driven economy. The 5 largest companies as a share of the S&P 500 make up 21% of market capitalization. It's off of its all-time highs, but it's still high enough to be concerning that 5 companies are 21% of the S&P and about 40% of the NASDAQ. That means 21 cents of every dollar you put in the S&P goes to 5 companies, and 40 cents of every dollar in the NASDAQ to those same 5, which also goes the other way around. These passive investments, these indices, if people start pulling money out, 21 cents of every dollar comes out of those 5 companies in the S&P and 40 cents of every dollar in the NASDAQ. That imbalance works both ways. And, through prior bull markets in history, leadership doesn't stay the same. So will these big 5 companies be the biggest 5 for all time to come? No, I don't think so. In fact, I think the next bull market is going to be a lot different, led by old economy stocks, not these high growth, high tech companies that are longer duration risk, because I don't think the next credit cycle is going to look anything like the one that we just had. I think it's going to be higher rates, higher levels of inflation, a shorter credit cycle as central banks come back in, supply side inelasticity, creating that inflation earlier in the cycle, compelling central banks to start tightening much earlier on than what we had seen prior. And the number of S&P 500 stocks outperforming the index is just 32%. This is not a good sign. This reminds us of what we saw, by the way, during the dot-com bubble and subsequent bust. I'm not saying that this time is the same as then, but it's very concerning to see such narrow breadth. And let's talk about why. Because when we look at the breadth here, we can see prior episodes of this led to poor outcomes. There's that dot-com crisis breadth. We know what happened next. We also have the great financial crisis that followed that bubble in real estate and financials and other companies in the fire, finance, insurance, real estate industry. We also have the European debt crisis. We have what happened leading up to COVID, which was the tightening tantrum, then the COVID crash, and then now is that last blip below on the chart. That market breadth is dangerous. It often leads to drawdowns, sometimes significant ones. I'm not saying this is a prediction. It's a risk factor to monitor. Office vacancy rates hit record highs. There is no normal coming back. This is the new normal. Post-COVID, a lot of businesses realized, wait, we don't need to have so much commercial space. We can have hybrid or remote work, right? We can downsize. The other thing is the economy is slowing. Businesses went way too wild on their commercial space allocation post-pandemic, and now they're pulling back. We see it in Google. We see it in Amazon. We see it in Meta. We see it in a lot of their smaller peers and counterparts, but also across a variety of different industries. And small businesses are going to be hit the hardest because banks are largely unwilling to extend them credit in this environment. They're having trouble paying their rent. About half of small businesses are late on their rent for their commercial space. And who are the biggest lenders for commercial real estate? Well, of all the bank loans, it's small and medium-sized regional banks. So it all kind of comes full circle, right? Those are the same banks that are going to see a hit from this as the chickens come home to roost. And that wall of debt starts to mature over the next several years for those commercial real estate loans or those commercial mortgage-backed securities. Systematic positioning in U.S. equities is at highs we have not seen in about 2 years. This is a concern because we're taking CTA positioning, risk parity, volatility-controlled funds, putting them all together, and we can see they are super duper long. So much for people being ultra mega bearish of this market. They're not. They're very long. The charts that you see that are saying hedge funds are super short, oh God, we're all going to die. That is taking one element of short positioning, the S&P 500 E-mini futures contracts, out of context and not looking at the rest of their book. And I think it's important to look at the rest of their book. If you look at one area of positioning, how they're hedging their long risk and say, wow, everyone's so bearish, we have to go higher. It's missing the big picture. They're not positioned bearishly. They're hedging more risk than they ever had. That means they're very long. And we can see it here as those flows into U.S. equities are on the rise. Look at the blue line, that's long flow. Look at the red line, that's short flow. What do you see? More people getting long, more folks covering those shorts, right? They're getting a little bit more short into this. So, we've had some covering going into April. Now they're starting to short again to cover that risk. But the net flow is what? It's going up. It's going up, and it means they are, based on these flows, getting longer, which we saw in the past chart. So sure, they're hedging their risk with more shorting, but they're getting aggressively long here. So overall, I would be a little bit concerned with the idea that everyone's bearish, everyone's short. It's not true when you look at managed money. It's not true when you look at hedge funds that have long short positioning. It's not true when you look at retail. In fact, retail has the highest portion of their net worth allocated into equities that we've ever seen. So people are still very long. They're still very bullish. The idea that everyone's a bear out there is a misnomer, and it's taking data out of context. It's looking at it in a vacuum and making these wild assumptions about it. So when you see folks talking that way, please be cautious. It means they are not looking at all the data. And we have rich multiples. This is more evidence of how long people are. Look at the NASDAQ here. Fed funds rates rising significantly. And yet the S&P 500 IT index, its PE is just under 25. Now, with rates as high as they are, that means risk premiums are very low. There's no reason for people to be this optimistically positioned in tech, a long duration asset with a lot of risk in a rising interest rate environment, a slowing economy. These are not the kind of things that you want to see. These are concerns because it means that there's not a lot of upside. Again, if we're starting a new bull market from here, it's going to be the most richly valued new bull market in history, which means it would be short, shallow, and have a lot of downside potential. I don't think we're in a new bull market. And in fact, during the Great Depression, not that we're in a similar situation, but just to give you an idea, there were bear market rallies that went up as much as 50% before new lows were made. In the wake of the dot-com bubble busting, there were 6 or 7 NASDAQ rallies over 20%. Each one led to new lows before we finally found a bottom. And after that bottom, we chopped sideways for 10 years in tech. I'm not saying the same is going to happen this time, but there are risks that we should be aware of as traders and investors. And the new regime of valuations is inconsistent with the price-earnings ratio of the past 20 years and prior. This is not where we want to be. Again, this suggests that if we're all getting long here, we're pricing this market to perfection, assuming that earnings are going to keep growing, that these stocks are going to grow into their valuations during a period where it becomes ever more likely that the economy goes into a contractionary state or a recession. These are two things that can't blend together. Then people want to add into that, oh, there's going to be a Fed pivot. Well, a Fed pivot's not going to happen without some kind of crisis, for one. And then also there's going to be a soft landing. So let me get this straight. Valuations are going to stay at a permanently high plateau and keep rising. The Fed is going to pivot, and we're going to have a soft landing. Those are things that don't fit together. We're going to have, in my opinion, a hard landing. Valuations are going to see a significant risk re-rating. And the Fed will eventually pivot when they break something big enough. That's my humble opinion. Of course, I could be wrong, but I don't think I am. And the NASDAQ is showing very weak breadth. We saw it on some of these other charts, but here's new highs versus new lows on a daily basis. The last reading was negative 166, which means there was 166 more new lows than new highs. What does that tell you? It tells you that there's very, very narrow leadership. The NASDAQ made a new year-to-date high. It's up 21% on the year. So some technicians would say we're in a new bull market. I would exercise some caution with that assumption because the internals are not showing that. There's 7 stocks that account for 90% of the gains year-to-date. That's not what we typically see in a new bull market. That's what we saw in the end of 2021 before the bear market started. And NASDAQ stocks, these are the top 10 in the NASDAQ itself, looking at their R&D. Amazon, Alphabet, Meta, Apple, Microsoft, arguably the biggest by just their nominal spending. But when we look at spend as a percentage of revenue, Meta and Nvidia are the largest and they stand out. But Meta is just setting their money on fire, as we can see. The metaverse has been a failed endeavor. The last quarter, they burned $4 billion of capital. And Mark Zuckerberg said, hey, we're going to kind of keep doing this. We'll be more efficient. We'll fire more MetaMates, but we're going to keep pursuing this along with AI. And maybe at some point we'll be able to monetize it. I'm skeptical. I think the whole thing is a bit of a ruse. I think that when Apple said you don't get IDFA data anymore, Meta was like, oh crap, we've got to invent some new gag that hopefully allows us to get that telemetry again, but at least allows us to kind of extend and pretend. And that's the metaverse, which is not new. Second Life 25 years ago, their capital city was called Metaverse City. Maybe it was 20 years ago. It was a long time ago. The idea of the metaverse is decades old. Central bank purchases of gold have hit the highest level on record. They are diversifying their reserves, probably a smart thing to do. Gold isn't the best hedge against inflation in dollar terms, but in other currencies it works reasonably well. It's also a good hedge against uncertainty. So This is interesting to watch. It doesn't mean that gold has to go much higher, though. An important fact that most people don't pay attention to is central banks lease their gold. That gold can be put out onto the market, and often it is in a way that can dampen upward pricing. So be careful. And international value versus growth relative valuations look attractive for value versus growth. Now, cheap can continue to get cheaper, but I do think value makes a lot more sense where we are with rising rates, with high inflation, fortress balance sheets, companies that pay dividends, that have high free cash flow. They're going to do better in this environment, in my opinion. That's the factor where I would want to be domestically and internationally. And finally, the last item I have here is bull markets versus bear markets. The current bear market had about a 9-month duration with a 25% drawdown peak to trough. The average bear market has a 20-month duration with a 41% drawdown peak to trough. So, I would just be a little careful assuming the worst is behind us. I don't think it is. Of course, I might be humbled by the market. That's what the market does. But the risks far outweigh the rewards where we are right now, in my opinion. So I want to thank you for watching. Really appreciate your support. Be sure to check out my work at macrovisor.com, where you can find more of my research and analysis. Until May 1st, we have a 50% off your first year launch sale for our premium plans running right now. And that's if you sign up for a monthly or a yearly plan. You get that discount. Also, check out TraderAid, where you can learn more about short to intermediate term trading, whereas MacroVisor is more about the longer term view, the bigger picture, and deeper dives into the economy. And if you want to sign up for TraderAid, we give you a 10-day free trial on the base plan. You get 20% off on me using the code Mayhem20. And then consider following me on Twitter at Mayhem for Markets, Mayhem number 4 Markets. And finally, be sure to like, subscribe, and share this content with your friends and colleagues if you enjoy it. And I will catch you next time, wishing you a great trading week ahead.